So take out your notes. I want us to discuss on the introduction to the business income. I had already shared the notes. Now, what's business income? So now business income is among the specified sources of income, which is taxable under Section 3, subsection 2 of the income tax. And a business can be operated either as a sole proprietorship, so various forms of business. I'm saying that a business can either be operated as a sole proprietorship or a partnership or as a company. Now, what's the difference between the three? Now, for sole proprietorship and partnership, there is no separate legal identity or there is no separate taxable capacity from the owners, that's the sole proprietor or the partners. But for a company is a person in the eyes of the rules. So that means we have a natural person, we have an artificial person. So a company is an artificial person in the eyes of the rule. And therefore, there is a different taxable capacity between the company and the owner or the shareholders. Good. So we are saying that a business can be operated as a sole proprietorship or a partnership or a company. Good. Now, what are some of the factors to consider when evaluating whether a business is the nature of trade? How can you know that these are business going on? So what are some of the factors to consider? Now, the major objective of a business is to make profit. So number one, you look at the profit motive. If the entity has a profit motive or the major objective is to make profit, so that means the business going on. So number one, we're looking at the factors to consider in evaluating whether a business is in the nature of trade or not. So number one, we're saying that is the profit motive. Then number two, you look at the nature of asset acquired. Nature of asset acquired. Now you cannot buy a lorry and then you claim that this is a personal car. I want to be carrying my my family using a lorry. So number one, you look at the nature of asset acquired. Then number three, you look at the method of financing. So what's the method of financing? Yeah, are you using the borrowings? Are you using the savings? So you cannot carry on a business which is not profit oriented. And in this case, you are taking a loan. Where will you get the amount to finance the loan, to pay the interest? So you look at the method of financing. Number four is the mode of asset acquisition. Yeah, is it a normal purchase or is it a lease? And then you look at the method of generating sales. Now, any business which is profit oriented, they do their marketing. If the business mostly is not profit oriented, it's hard for them to do the marketing or do some advertisement. So if you see a business being advertised, know that their underlying objective is to make the profit. Good. So those are some of the factors to consider when evaluating whether the business is in the nature of trade. And now let's look at some of the taxable business income. Now this is what happens. Now for tax purposes, we have the incomes and also we have the expenses. Now for incomes, we have two classifications of incomes. We have the taxable incomes and then we have non-taxable income. Taxable income, they are income which are subjected to taxation. Non-taxable income, they are income which are not subjected to taxation. When it comes to the expenses, we have what we call allowable expenses. Also, we have disallowable expenses. So for the income, it's either taxable and taxable. For expenses, it's either allowable or disallowable expenses. Now, when you talk about the taxable income, now note that all the income generated by the business, they are taxable. Mostly any income generated on a day-to-day basis or what we call the operating income are taxable. Except, so you're saying that all incomes are taxable except the non-taxable income. So what you need to know is what? non-taxable. That all income are taxable except non-taxable income. Good. For expenses, any day-to-day expenses, that's what we call the operating expenses, are allowable expenses. So note that all the expenses are allowable except disallowable expenses. So all expenses are allowable except disallowable expenses. So that means if you want to understand tax well, kindly know all the non-taxable income. Any income which is not in that category must be taxable. Also for the expenses, know that all the disallowable expenses, know the category of all disallowable expenses. So any expenses that not fall under that, that means it's allowable expense. So now let's look at some of the taxable business income. Taxable business income. But there is something I've said that all income are what? Taxable, except what? Non-taxable income. So kwa hivyo, let's look at non-taxable income. Leave the taxable income. Now let's go to the non-taxable income. Non-taxable income. Now, when you talk about taxable and taxable, let me take you back to financial reporting. Now, how do you determine the profit? Profit is all about the income minus the expenses. Now, for tax purposes, if you want to get what we call the taxable profit, you'll take the taxable incomes, then you deduct not just expenses, but you just deduct the allowable expenses. Now, what are those allowable expenses? Now, allowable expenses are those expenses that reduce your tax liability. Right together, because the more allowable expense you have, the lower the profit, right? The lower the profit, the lower the tax. Right together. Yeah. So allowable expenses, they are those expenses which will be allowed for tax purposes. That means it will reduce the tax liability. Now we have some expenses such as depreciation. Depreciation is an expense, right? But it's argued that depreciation is not an actual outflow. So therefore, it's a desirable expense. So if you had recognized a depreciation, for example, of 300, that means they should not be allowed. In short, this expense should be taxed. So for you to understand. So note that allowable expenses, the expenses which reduces the tax liability. Good. So now we are focusing now on non-taxable incomes. One is the foreign investment income. Any income earned from the foreign investment, that income will not be taxed. Why? Because that income is deemed to have already been taxed at the point of origin. Are you together? What about the foreign exchange gains? Now, foreign exchange gain, that one is not a foreign income. Are you together? That's an income by the virtue of exchanging the currencies. So that one is an operating income. But foreign investment income is an untaxable income. Number two, we have reduction in general provision for bad debt. Yeah, we know very well that an increase in provision is an expense. A reduction in a provision is a what? Is an income. So that reduction in a provision is not taxable income. Also, you have what? Unrealized profit. Yes, there's profit you expect, but you have not yet realized. So that profit will not be taxed until the income has been realized. Also, you have the capital gain on the sale of asset. Now, that's what we call it's an operating income. If the company sells its motor vehicle, assume the carrying amount was 2 million, but they sold it at 2.1. So that means there was a gain of how much? 100. Now, this 100 is what we call the capital gain. Now, this income will not be taxable. Right together, because it's not an operating income. Do you know what's an operating income? Now, operating income, they are income from day-to-day operation. For example, in a bank, what are the operating incomes? The interest income. Right together. An insurance company, premiums. KCE college fees. That's what we call an operating income. What if we decide to sell some chairs and then we sell them at a gain? You see, that one is not our main core. Are you together? So any profit emanated from the disposal of those assets will not be taxable. So that's what saying the capital gain on disposal of assets. Number 5, additional capital introduced. If you inject more capital, for example, 3 million, you see in your bank account, it will be reflected as on the debit side. So that income will not be taxed. Also, dividend income, where the entity has at least 12.5% of the equity ownership. So where a company controls another company or has shares to an equivalent to at least 12.5% of the ownership, that dividend will not be taxed. So, because remember, dividend attract what we call the withholding tax. Withholding tax. Good. Then number 7, interest income from post bank. So interest income from post bank. But if you get any other interest income, maybe from the banks, from the circle, that interest, number 1, will be taxed. But in case it's an interest income from the post bank, it will not be taxed. Another one, interest from the government infrastructural bond with a maturity period of more than 2 years. And actually, nowadays, all the government bond, the maturity period is more, infrastructural bond, the maturity period is more than 2 years. So that means if you invest in a government infrastructure bond with a maturity period of maybe from 2 years, 3 years, 4 years, 5 years, any interest earned will not be taxed. Good. Number 9, insurance compensation for non-current asset. If you had an asset which was involved in an accident, and then you received some compensation, now that amount will not be taxed. But in case it's an insurance compensation in relation to loss of stock, remember, it's a current asset, right? In case some stock were destroyed, then you are compensated by the insurance company, that amount will be taxed. But in case it was insurance compensation in relation to non-current asset, will not be taxed. Good. And then number 10, inheritance and what? Dowry. That's on an individual what? Yeah, on an individual basis. Can you go through them again? Just go through in the non-taxable income. Which point is not clear? Explain again. So let's summarize them. Actually, the key that should be at your fingertips. Number 1 is the foreign income investment. And you take that one. Just take that. Let's go to number 3. Number 2. Unrealized profit. Also take that. Unrealized profit. Another one, number 4. Capital gain on sale of asset. Also take that one. Number 6, dividend incomes. Also take that. Dividend income. Another common one is the interest income from post-bank and interest from the government infrastructure bond with a maturity period of 2 years. Yeah, those are the key or major incomes which will be coming across under taxation of business income. Good. So now quickly, let's go back to where we had the taxable business income. Now, what are taxable business income? Now, for the taxable business income, number 1, you have gain arising from buying and selling. Yeah, that's what we call the gain from day-to-day operations. Number 2, realized foreign gains. Then number 3, we have balancing charge and trading receipt. What is that? I'll come to explain later what is that. Mostly for a going concern business, there are some assets which are deemed to be taxable when you dispose some assets. Number 4, amount of insurance a compensation for the loss or damage of stock. Yeah, we have seen that in case there was loss of stock and you received some compensation, that amount will be taxed. Why should it be taxed? You see, the assumption is what's current assets or the inventory? They are there for trading, right? So that means if they were destroyed and you are compensated, it's like you sold to the insurance company and the insurance company paid you back. Are you together? That's why it's treated as a what? As a taxable income. Because it was destroyed, you have been compensated. It's like selling the stock and receiving, selling the inventory and receiving the amount. Then number 5, bad debt recovered, which has been previously been written off and was considered what? Allowable. Now, for bad debt, we have 2 types of bad debt as an expense. Now, we have what we call the specific bad debt, and we have general provisions. Now, specific bad debt, they are bad debt which you have confirmed with surety that you will not receive the amount, and this amount is allowable. But general provision is a disallowable expense. Now, in case there is some amount you had confirmed you will not receive, that means it was written off and was considered as allowable expense, maybe worth 500,000. And then on the other financial year, you recover back the amount. But you see, previously has been treated as allowable expense. Now, bad debt recovered is always, how do you recognize bad debt recovered? How do you, in financial reporting, how do you recognize bad debt which has been previously been written off, but then have been recovered? How do you treat that? As an income. So bad debt which has been previously been written off and then has been recovered will be treated as a what? As an income. And in this case will be a taxable income. Good. So now I think we are clear with the incomes. That's the taxable and non-taxable income. Now let's go to the expenses. Remember you said that all expenses are what? Allowable, not disallowable. All expenses are allowable except disallowable expenses. So what you need now to understand are what are those disallowable expenses? Yeah, good. So let's go to disallowable expenses. That's page 2. Page 2 of your notes. Disallowable expenses. Now, the expenses not only or exclusively incurred in day-to-day income generation. Can you understand that? Day-to-day. In short, they are not operating expenses. Any expense which is not operating expense will be regarded as a disallowable expense. And what are those expenses? They include, number 1, capital expenditure on acquisition of non-current. Yeah, during the year, the company acquired some furniture, fitting, or a motor vehicle. Now that one is an outflow, it's not an expense. Or how do you do that? If the company acquires a motor vehicle, number 1, you debit the asset account, right? Then you credit the bank account. Now it goes to the income statement. Are you together? But expenses now relating to that motor vehicle is what you treat them as an expense. As an expense, yeah, such as fuel and maintenance expenses. So one of the disallowable expenses is the capital expenditure on acquisition of non-current assets. Now, non-current assets will only qualify for what we call the capital allowances or wear and tear. Good. Number 2, personal and private expenses. Yes. For a business, any expenses that does not relate to the business, maybe by the sole proprietor or the partners or the directors. Now that expense, if it does not relate to profit generation in the company, is regarded as a private expense, and private expenses are disallowable expense. Good. Number 3, depreciation, impairment, also provision, as well as non-cash what? Expenses. Yeah, all depreciation, amortization, impairment is just a provision. So therefore they will be disallowed. So what will be allowed on an asset is what we call the capital allowance or investment allowance or wear and tear. Good. Number 4, general provision for bad debt. But in bracket I've written that for specific what? Yeah, we have said that Specific bad debt are allowable expenses, but general provision is a disallowable what? Expense. Good. Number 5 is what? All provision. Now, provision is not an actual outflow. It's money setting aside for future uncertainty, such as provision for doubtful debts, provision for cases in the future. So all those provisions are disallowable expenses. Number 6, tax-related expenses, such as tax penalty, tax interest, all that, VAT, etc. Also, number 7, fines and actually any expenses of wrongdoing is a disallowable expense. Any cases, I mean any expenses for wrongdoing, such as maybe breach of contract. What else? Penalties, also fines. And we have some expenses of the company, maybe by the director. Kampuni na mulipianga, sawa sawa. Now, for example, you have an office, I mean the company motor vehicle. And then you are charged some fines, maybe due to traffic offense. So the company will pay, It's not a personal asset, it's a company asset. So now that expense, how will you treat it? Is it allowable or disallowable expense? Yeah, disallowable. We have said that all expense of wrongdoings are disallowable expense. But will you disclose that? As an accountant, we just say motor vehicle expense expenses. Lakini tukikuja kujua ilikuwa ya fines, you also need to disclose because that one should be disallowable expense. But as an accountant, how will you recognize it? Motor vehicle expense. Yeah, motor vehicle expenses. Number 8, capital repairs, including the cost of extension. And now when you talk about the capital repair, for example, you have a motor vehicle, repair costs are allowable expenses. Are we together? Repair costs, because they are recurrent. What about replacement of an engine? Do you do it often? No. Now that's what we call a capital repair. A capital repair. So a capital repair becomes a disallowable what? Expense. And a capital repair qualifies for wear and tear. Good. And then number 9, legal fees and other professional fees of capital. It's actually legal fees and professional fees, such as audit fees, are allowable expense. But in this case, we are saying that legal fees and other professional fees of capital nature in relation to number 1, borrowing. Yeah, and IAS 23. So you know what we call the borrowing cost. Yeah, for example, the lawyer, you're in the process of getting a loan, and then you incur some expenses, legal charges for the lawyer to prepare some documents. Now that's what we call preliminary expenses, which should be capitalized under the cost of borrowing. So those expenses are disallowable expenses. So you're saying that professional fees of capital in nature in relation to borrowing. Number 2, valuation of property, also preparation of partnership deed, and what? With the memorandum of what? Association. Good. Yeah, those are what we call preliminary expenses. Number 10, other expenses regarded as non-business income. Not non-business income, but non-business expense. Can you change that? Other expenses regarded as non-business expenses, e.g. donation. Is donation a business expense? No, but note that we are saying that donation is a disallowable expense. A donation will only be allowed if they are made to the charitable organization, such as what? Orphanage, churches, nyumba yazo inaitangwa waje? Nyumba ya wazee. Because orphanage ni kwa yatima, right? Yeah. Daycare. Yeah. Na kwa watoto. I see that one is an uncharitable, it's a charitable organization. Yeah. What if you donate to the political party? You donate to the football club? So now those are some of the disallowable expenses. So note that all the other expenses which does not fall under that category, they are what? Allowable expenses. So disallowable expenses. So I'm giving you 2 minutes. Can you go through that? Only desirable expenses. So now you can highlight the following. Now the major desirable expenses. Number 1 is the capital expenditure, tick that. Personal expenses, also you can tick that. Depreciation, impairment, amortization, also you can tick that. Number 5, all provisions. Now, whenever you see it was a provision expense, that one is a desirable expense. Let's go to, actually those are enough. You see that capital expenditure, personal expenses, depreciation, or provision. Also number 6, all tax-related expenses. Tax-related expenses. Good. So now we can go back now, we look at what are some of now allowable expenses. Yeah. What does allowable expenses relate to? Allowable expenses. Now, allowable expenses, the expenses which are wholly or exclusively incurred in the production of income. In production of income, that means day-to-day operation. The guiding principle is subject to the provision of the Income Tax Act, and they include, number 1, trade bad debt, which are what? Specific, that's the specific bad debt. Number 2, we have capital allowances, such as investment allowance, wear and tear. Number 3, we have subscription to a trade association. Number 4, legal cost in connection with acquisition of a lease of not more than 99 years. If it's more than 99 years, that one becomes a desirable expense. Interest on loan for business, development. Yeah, interest on loan is a day-to-day operating expense because after all, you're borrowing to finance the business. Number 6, advertising expense or marketing expenses. Yeah. Also, we have those brought forward from previous years with a limit of 4 years, but that one has been adjusted. Now this can even be carried out for even 5 years. What does it mean? Now note that if a company makes a loss, if you take the income minus expenses and then you have a loss or you have a loss, we don't tax loss. You only tax the profit. Now this loss in the next financial year will be considered as allowable expense. What if the other year also you make a loss? Also, that loss you can also be offset in the other year for a limit of 4 years, but now have been increased to 5 years. Good. Number 8, legal fees paid on listing securities. Then costs incurred for prevention of soil erosion, scientific research related to business, and all other expense except except disallowable expenses. Good. So now that's all about the income, taxable and untaxable expenses, allowable and disallowable expenses. And actually, once we are done with this topic, so I can also argue that you can also sign in the app. You look at the video I had done for introduction to business income. Yeah, so that kind of this topic, I mean this today's class, the introduction should be at your fingertips because that's what we'll be doing for all the other remaining topics of taxation. So now let's look at specified sources of income. Specified sources of income. Now, specified sources of income are income from different channels which cannot be offset against each other. And number one of the specified sources of income is the business income. What is business income? Now, business income is day-to-day income. Now, for example, as a school, our business income are the school fees. Are you together? Yes. What if now we invest, assume that we buy share in another company, we'll be earning dividends. That one is not a business income. If we invest in some properties, we'll be earning some rentals. Also, that one is not a business income. So business income, their income from day-to-day operations. Number 2, we have employment income. That one is on an individual basis. Then number 3, we have other investment income. Investment income. If you invest in shares, what do you get in returns? Dividends. Good. If you invest in bonds, what do you get in returns? Interest. Good. Yeah, those are the investment income. Number 4, we have property income. Property income. If you own property, what do you receive? Rent. So rental income. If you have copyright or patent, it's also part of property, right? Intellectual property. What do you earn in return? Royalties. Good. Then number 5, we also have the farming income. And then number 6, we have the post-employment or the pensions income. Yeah, post-employment income. Now, those are some of the specified sources of income. Number 1, we have the business income. That's day-to-day income. Employment income. Investment income. That's the dividend income or the interest income. Property income. That's rental income and royalties. And then number 5, we have the farming income and then the post-employment income. Now, why do we have to separate them? I'll come to explain why do we have to separate them. It's because of any income or any loss, or whenever you have a specified source of income, is an income that you cannot offset one income against another income. I'll come to explain that. Good. So that's all. Now, we said that we have 3 forms of business. We see that a business can be run as a whole. Yeah, sole proprietorship. or as a what? Or as a partnership, or as a company. Then we see that for sole proprietorship and partnership, there is no separate legal identity, or there is no separate taxable capacity between the business and the owners. That's why if you own a business, which is not a company, are you getting? So how do you pay your taxes? Once you determine the profit from the business, you combine that income together with any income you earn as an individual, and then it will be subjected to graduated scale rate of tax. Are you together? What about a company? For a company, once you get the profit, it'll be subjected to a tax rate of 30%. 30%. So you're saying that any income from the company subjected at the normal rate of 30%. But for the two, there is no separate legal identity between the business and the owners. So the income for the business will be combined for the owner, and then you tax them using this graduated scale rate of tax. Is the rate we're using in our last class, when you're doing cross-border issues, right? Yes, the other class, yeah, that's what we call the graduated scale rate of tax. Now let's start with the taxation of sole proprietorship. And a sole proprietorship business does not have a separate taxable capacity, and the profits are taxed on the owners using the graduated scale rate of tax. Salaries paid to owners, personal expenses, and drawings are not allowable expense. Those are disallowable expenses. If you have a business, this is your business. Assuming you have a school, which is not a company, and then you are under salary. So any amount of that salary expense becomes a disallowable expense. Why is it a disallowable? Why is it disallowable? But you are working there. Assume you have 10 employees. You have 10 employees. You are one of the director, actually an active director. So any salary paid to that director will be a disallowable expense. But any salary you pay to other employees will be allowable expense. What is the case? Remember, you're saying that there is no separate legal identity between the partner and the partner or sole proprietorship and the business. So it's the same person, right? It's like taking from this pocket, you take it to the other pocket. Are you getting? Because there is no separate legal identity. Also, if the business is being run in a building owned by the owner, so this is your building, and they usually do pay rent, right? Now that rent will go to whom? To the owner, right? So now that expense will be regarded as disallowable expense. Disallowable expense. Good. Now let's look at taxation of partnership. Taxation of partnership. Taxation of partnership. Now, a partnership does not have a separate taxable capacity, and their profits are taxed on partners using the graduated tax rate scale. Each partner is taxed on aggregate of the following from the partnership. Now, in case of a partnership business, how do you determine the tax liability of each partner? Usually do prepare an allocation schedule. How do you prepare our allocation schedule? Assuming you have two partners, we have partner A, partner B. Then here you have the totals. So you'll take any salaries, wages, any commission you had paid to that to those partners from the business. Then you also add interest on capital. Yeah, sometimes with the partnership, you see the capital you had injected in the business, they usually do pay some interest. Now that interest will be paid back to the partners. So to the partners will be regarded as an income. So you add the interest on capital. Then you deduct interest on drawings. Now, once you do that, now that's how now you get a profit or loss share. It can either be a profit, it can either be a loss. How do you determine that it's a profit or loss? Come show you how to determine that. And that's how you get your taxable profit. And this profit we have here, the total profit, should be the same as the profit you have gotten from the business. Taxable income minus allowable expenses. Then from there, now you can add other income, other specified income. Other income. Such as rental income. Assume partner A has some rental income, partner B does not have. Also farming income. Assume partner A is not a farmer, but partner B is a farmer. Then from there, now you aggregate the total. And that's how you get what you call the adjusted taxable income. So first of all, determine the taxable profit from the business. And then for each partner, now you can also aggregate any other income earned by that partner during that financial year. Good. Lastly, now let's look at taxation of corporation or companies. Taxation of corporation or companies. A company has a separate legal identity and therefore has a separate taxable capacity. Profit are taxed at the rate of 30% for resident companies and at 7.5% for non-resident company. Good. So the normal tax rate is 30% for resident company. For non-resident company, the rate is 37%. Then transaction between the business and the owners or the shareholders are considered to be business what? Transaction. Yeah, because in this case, there is separate legal identity. But between a partner and the partnership business will not be regarded as a what? As a business transaction. Then director salary is an allowable expense. Director salary is allowable expense. What about partner's salary? It's allowable expense. Are you getting the difference now between the two? If you're a director, that means you're one of the shareholders. Any salary you get is allowable because there is separate legal identity between the director and the company. But in case it's a sole proprietorship or a partnership, the expense, I mean the salary will be a disallowable expense. Good. Any question? So now we go to the formats of presentation of financial statement. It's time for prayers. I can have 5 minutes. Let's proceed. So now let's look at the format of determination of taxable income. Now, in determining the taxable income for the period, the following two formats are adopted. So we have two formats, depending whether it's a complete or incomplete record. So number one, in case of complete, incomplete record, case of incomplete record. Now, whenever you're given an incomplete record, this means it's upon you now to prepare it from scratch, the income statement. So when preparing the income statement, if it's a normal merchandise or general merchandise, you take the sales, then you raise the normal cost of sale, and that's how you get the gross profit. Once you get the profit, now you can add other operating incomes. So you add other operating incomes, not all the incomes, but other operating incomes. Then you deduct allowable expenses. For deducting the expenses, only the allowable expenses will deduct. And what you get here is our taxable profit. Now, this taxable profit is now what we call the business income. Now, once you get the business income, now you can add other specified sources of income. Other specified sources of income, such as rental income, interest income, royalties. You add all that. Now, what you get here is our adjusted taxable profit. As simple as that. So you take the sales, there's the cost of sale to get the gross profit. Then you can add any of the other operating income. Then you deduct allowable expenses to get the taxable profit. Or alternatively, now this one is a normal merchandise. What if the company offers services? Okay? For example, a bank. As a bank report sales or insurance company, they're offering services. Yeah, so in case of those services, so just take the taxable incomes and you deduct allowable expenses, as simple as that. You just need to know what are their major operating income, what are their operating expenses, their allowable expenses, and that's how you get now the taxable profits. Now, once you get the taxable profit, now you can add other specified sources of income. And that's how we get our adjusted income. So that's a case of incomplete record. Now, what if now you're given the complete record? Number B, in case of complete record. Now, a complete record, this is where you are given the income statement. That means you're also given the profit. You have the income, you have the expenses. But now what you have is accounting profits. You know what's accounting profit? So that means an accountant had taken all the income without classifying the current and the taxable and untaxable. Also expenses, had deducted all the expenses. So now you're the taxman. How do you adjust? Now for the taxman, you just need the taxable income and allowable expense. How do you prepare that? So in that case, now you'll start with the reported profit. So sasa unaanza huku panda. Then of the expenses he had deducted, we have some expenses which he was not supposed to deduct. Are you together? Now that's what we call disallowable expense. He had deducted, what do? You add them back. So you add back disallowable expenses. Once you add back disallowable expenses, then you raise allowable expenses never deducted. You raise allowable expenses never deducted. And this one usually is just the capital allowances or the wear and tear. So that's wear and tear, you deduct that. Also, you deduct, when you're determining the income, you had included all the income, but you have some income which are not supposed to be taxed. So you eliminate them because they're already included in the total profit. So you also deduct non-taxable incomes. Yeah, for example, if the company had disposed an asset at a gain, that amount had been included as other income, but that income we said is non-taxable. So you eliminate that. Also, you eliminate, we have some taxable income, but they're specific. If the company had some rental income or investment income, that means has already been included in part of incomes. But you're saying that that income is a specified sources of income. So you raise specific incomes. Now, what you get here is our taxable profit. And this taxable profit is what we call now the business income, the income from day-to-day operations. Now, once you get the taxable profit, now you can add back now the specific income. You add back this specific income. You deduct, and then you add it. And that's how you get the adjusted taxable income, adjusted taxable. Now, why do we have to deduct and then add back? Because we see that you cannot offset one source of income against another income. Now, this is what I mean. For example, from the business income, day-to-day operations, you are generating, and then there was rental income, an amount of 2 million. Then you also have farming income, a loss of 1,000. So give me the total taxable income. How much is that? This one you don't require a calculator. How much is that? Good. 8? Is that 8,000? Yes, the teacher is always right. I know you're trying to confirm. Now, let me repeat my point. I'm trying to say that you cannot offset one source of income against another source of it. So what happens? Business income is a specified source of income. Rental income is among the investment or the property income. Farming income is a specified source of income. For tax purposes, from business, that's okay. From rental income, it's okay. Now, farming income, ilikuwa raw, sawa. So hiyo ataku exempt, hiyo ata access, sawa. So in this case, they only access 6 and 2. So that means the taxable income will be 8. Now, assuming from the business, you made a loss of 9 million. That's the business income. But from rental income, you had made a profit of 100,000. And in this case, KRA, you see, if you set off, that means you'll end up still with a negative, right? That means you not pay tax. No, KRA watakwambia, we can allow this one, you don't assess it. But this 100 was an income. So the taxable income they assess is how much? 100. So that's why you have to separate the specified sources of income. That's why you have first of all to deduct them to determine how much was the actual income from day-to-day business. Then from there, now you can assess them individually, the specified sources of income. Good. Then before we do some computation, I want us to look at installment tax. So what are installment tax? When does the company pay taxes? Now, assuming the year, so first of all, let me run this. Now, according to understanding, if the financial year starts on 1st of January, let's assume 2020, 2021, that means the financial year will end in 31st of December, 2021. So when do you prepare the financial statement? When does the company prepare their financial statement? At the year end. So the year ends on that 1st December 2021. So which date will they prepare? I said year end. So that means by that 1st December 2021, will have they prepared the financial statement? Okay, when do they prepare? You know, now you are finalizing, eh? You need to know when do we prepare the financial statement. The first month of the year, Maoni yao wengine ama hamna maoni? Sorry? 6 months after the year, the first month, within the first month, 6 months, maoni? Hawana maoni. What do you think? Next year, between 1st of January and the 6th month, Yeah, actually, what happens? Once the year ends, that's not when you prepare the financial statement. So, but yes, you're given 6 months. But mostly what happens as a company, once the year ends, you need to hold an AGM, right? And you hold an AGM, you know, say, dividend ngapi. So that means, yes, you're given 6 months, but most of the company, they need to prepare within the first 3 months. You prepare the financial statement, they get audited, then you call for an AGM. So, before now, the financial statement are authorized for issue. So that means once you prepare the financial statement after the year has ended, that's when you determine how much was the profit for the year. Assuming that once the year ends, let's assume now you'll determine the taxable profit maybe on February, and realize that you had made a profit of 10 million. Tax rate is 30%. 30% of 10 million is how much? 3 million. When did you pay this 3 million? So now my question is, when do the company pay the taxes? The tax liability for the financial year ended 2021 was 10 million. I mean, the tax liability was 3 million. When do you pay that tax? The next year. Use the previous year tax. Good. That's what happens. Now, this is what happens. You see, this is February 2022, right? Now, by the time the company is determining that the tax liability is 3 million, actually, by the financial year end, already they had already paid this 3 million. But you can ask yourself, how do they know? How do they know that they make a profit of 10? That means they're supposed to pay a tax of 3 million. Okay? You see, you don't pay the tax at the end of the financial year. Are you together? Yes, you pay them in installment in 4 installment. And how determine the installment payment? Because we are saying that at the start of this financial year, 1st of January 2021, at the beginning, the company knew how much tax they're supposed to pay within the entire financial year. They usually know at the beginning, right? Together. So now that tax, they start paying in installment. How do we determine the amount of installment tax? So to determine the amount of installment tax, they usually take the previous year tax, then you multiply by 110 That's the mentality of KRI. That if last year you had paid 10 million, this year your tax liability should increase by 10%. So you take the previous year tax, they multiply by 110. Now what they get, so already now the company knows that at the beginning of this year, within the year they'll pay that tax. So how do they pay? They distribute into 4 installments. So it will be paid on or before the 20th of number 1, the 4th month, number 2, the 6th month, number 3, 9th month, and number 4, 12th month. So that is April, June, September, and December. So here they pay 25%, 25%, 25%, 25%. Right together. So that means by the financial year, they had already paid the total tax. Then once they prepare the financial statement, that's when they determine how much was the actual tax liability. Now, assuming that during that financial year, they had already paid 2.5. But based on the profit for the year, the actual tax liability is how much? 3 million. That's how now they determine there is a balance they need to pay. And that's why you have what you call the current tax liability. What if they had overpaid? That means during the year, they had paid a tax of 3.5, but the actual tax liability was how much? There's an overpayment of 0. Yeah. At the beginning of the year, that one will be recognized as what? That's what we call the current tax asset, right together? Yes. And the current will not refund. So what will happen? It will be set off against the tax liability for the other period. Good. So I think I've explained that. So we take a 1-minute break, then we do taxation of banks. And so that's all about the introduction of business income. So you can watch those videos in our app. It's well explained. And then for those using the apps, there is a question we did, a topic, cross-border issues. Now, cross-border issues, I had done a question under VAT. I did VAT, then the last part I did cross-border issues. But since the rate has changed, we have another video, of which some videos will be uploaded next week. Actually, most of the videos of taxation, for those who are relying just with videos, because the rates has changed. So and that's what I want us to look at, new capital allowances. For those who are done the previous tax. So remember here in here, used to classify class 1, class 2, class 3, class 4. All that has been merged. And now you don't have to cram because always will be provided with the schedule. So can you take out your past paper, the first page of your past paper? The first page of your past papers. You can either use for August 2022 or for April 2022. So now let's discuss that. That's investment allowances. So currently, they have classified all the assets into 4 classes. And that's provision is known as now the investment allowances. So now let's start with the first one. You're looking at the investment allowances. Because that's what you'll be doing on a daily basis. I mean, whenever you are doing business income, for the remaining all the topics are about that. So the first class, number A, it's on buildings. You see, under the previous rates, we used to have what we call ID, IBD with various classes, commercial and commercial, so we don't have to cram that. So actually, it's not a topic. Before it used to be a topic, but you don't have to teach it because now you have just the consolidated rates. Yeah, now the first part, we have buildings. Hotel building, now we look at the rate of investment. It will be 50% for the first year of use. Then 25%, angalia hapo juu. That's on residual value per year on reducing balance. What does it mean? Hotel building, also the first, second bullet, we have building used to manufacture. That's what we call the manufacturing building. Also hospital buildings, the rate are the same, as well as petroleum or gas storage facilities. It's 50% for the first year of use. Then 25% on residual value per year on reducing balance. Now let me interpret that because most students were not able to interpret that. Now assuming you have the financial year, year 1, year 2, year 3. Then you constructed maybe a school or maybe a manufacturing plant worth 20 million. So how will you claim the capital investment? First year, you'll take 50% of 20 million. That means you'll claim an investment allowance an amount of 10. Then from year 2, year 3, year 4, year 5, the rate will be 25% reducing balance residual value. How much the residual value? So you take 20 million, you minus 10. So the residual value is how much? 10 million. So how much will be that? 2,500. Year 3, you'll take 25%. You see the residual value was 10. You'll take 10, it's on a reducing balance. So you erase 25, what you have already provided for, minus 25. So it will be 25% of 75. That together. So how much is that? 1870. What about year 4? Year 4 now you'll take 25%. You can take 10. First of all, you minus 25. Then you minus 1870. Or you take 10 minus 25, you get 75, right? So you take now 75 minus 18. Yeah. It's based on the written down value. So you know what's net book value? What is net book value? Is the cost minus depreciation. Now for tax purposes, we call it written down value. Now this is the cost minus capital allowances. That's what we call written down value. For accounting purposes, it's net book value. The cost minus depreciation. Good. So that's what we mean by residual value per annum on reducing balance. Now, still at part A, you also have educational or hostel buildings. So it will be as well as commercial buildings. Now, what are commercial buildings? Now, let me explain what are commercial buildings. Now, this building will qualify at 50% year 1, falls under this category. Do you have offices? Yes. Do you have the showrooms? Conference rooms? Gym? Now, that's what we call now commercial buildings. Now, commercial building will qualify at the rate of 10%. Good. Yeah, so commercial building, so it's 10% per year on reducing balance. Then another thing I want to explain is what we call auxiliary assets. What are auxiliary assets? Yeah. Now, this building, kuna vitu kama lifts, water tank, things to do with like backup generators, perimeter wall, parking. Are you getting? Now, those are assets directly attached to that building. They are known as auxiliary assets. If you have parking, you incur some costs for parking. Yeah, setting a perimeter wall, all that cost will be included to the cost of building. If the building is qualifying at 50% the first year, also that cost will be the same, right, together. Yeah, so that means if the building was 20 million, and then you incurred some cost for perimeter wall, parking cost, all that, total to 1 million. Also, the cost will also be included. Then you have also said some auxiliary assets, such as escalators, yeah, backup generators, water pump, water tanks, all that. Now let's go to the second part. The second part is machinery. Now the second part is on machinery. So now part A was building. Number B, machinery. Now the first class we have machinery used to manufacture. That's what we call manufacturing machinery. So it will be at the rate of 50% for the first year, 25%. This, I mean, residual value. Hospital equipment, ships or aircrafts. Are we there? Yes. A ship or an aircraft, how will you provide the investment allowance? 50% for the first year of use, and then 25% on the residual value, reducing balance. Then we have motor vehicle and heavy earth moving equipment. In short, it's all about self-propelling assets. You know, before you used to have class 1, heavy earth moving self-propelling assets. We also used to have class 3, other self-propelling, the rate were totally different. So in this case, they have merged all the self-propelling assets, such as what? Tractors, bulldozers, vehicles, tuk-tuk, motorbikes, anything to do is self-propelling, right, together. And ingine, which is self-propelling, tippers, all those. So it will qualify at the rate of 25% per year on reducing balance. Then we have computer software, computer hardware. The rates have been merged. Software used to be at its own class. Now all the computer software, hardware, calculators, printing machine is at the rate of 25% per annum. Furnitures and fittings. All the furnitures and fitting also includes partitions. Yeah, the rate will be 10 per. Actually, what used to be at the rate class 4. See, class 4 used to be other machinery, not in class 1, not in class 2, not in class 3. So the rate is 10%. So furnitures, fittings, all those. Telecommunication equipment. What are telecommunication equipment? CCTV iko wapi? The CCTV telecommunication equipment. Ama what are telecommunication equipment? That's simple. Hiyo ni assignment. Mbona mjue what are telecommunication equipment? So. Good. Then film equipment used by local producers. Also, machinery used to undertaking operations and prospecting rights. Yeah, they are called mining assets or mining equipment. So we shall discuss that when we'll be doing taxation of petroleum companies. And then other machinery. Yeah, any other machinery you know, such as what? You have said partitions, neon sign. Do you know what a neon sign? Or billboards? Yeah, billboard is part of an asset to a company, right? Yeah, all those would be at the rate of 10%. Then class C, we have the purchase or acquisition of right to use fiber optic cables by telecommunication operation, 10% reducing balance. Farm works. This one is a ukulima, It's 50% in the first year of use and then 25%, yeah, reducing balance. Good. So that one you don't have to cram anything, because after all, ukishindwa just go back to that table. And look what you wanted. It'll be given the rate. Be given that schedule. So now let's start with business income. Now taxation of business income. Taxation of business income. We start with banks. Banks. How do the bank operate? What are the major sources of incomes? Are the interest on? Yes, interest on loans. What are their major expense? The opposite. Customer deposit is not an expense, it's a liability. Are you together? Now, liability gives rise to an expense. And that expense is the interest on loans. I mean, interest on customers' deposit. Loan to a bank, it's an asset. Are you together? Because from that loan, they expect some interest income. So it's giving rise to an income. So that means interest on loan is an income. That means loan is an asset to the bank. Also, the major expense are the interest on customer deposit. That means customer deposit is what? It's a liability. Yeah, the bank, they're holding money that does not belong to them, belong to the customer. So therefore becomes a liability. Good. So now let's do that question. December 2011, question 3. Yeah, the question is already in your notes. If you have the notes, you can use that question. Yes. December 2011, question 3A. Yes, I have already written a question for you. Mayona, you see I'm a good teacher. Do you appreciate by the way? Ama mnaonanga hiyo ni kazi yako. But whenever nikose kufanya what you expected, mnaanza kucomplain. You don't always appreciate. Imagine taking time to prepare notes for you. Naandika illustration and I know you have the past papers. But najua it will take 30 minutes to search for the question na uikose. But after all, you're human beings. Kitu mzuri, fanya makosa. Hiyo ndio time. Unaweza kuchat vizuri. So now let's do that question. The following is a statement of comprehensive income for Pesa Commercial Bank Limited for the year ended that 1st of December 2010. We have the incomes, we have the expenses. Now, up to that, is it a complete record or incomplete record? Don't guess. Is it a complete record or incomplete record? What's the difference between a complete and incomplete record? Complete are what? Complete record are completed. Usiangalie swali sana, haita change, niyo umeona. You know, you're pretending it's like you are looking for a clue. There is no clue there. It's a what? And that's that. We see that a complete record is where you are given the income statement. Are you together? Income, expenses, and the profit. That's what you call a complete record. In complete record, you are just given a trial balance. It's upon you to extract incomes, expenses, assets, liability. So this one is a complete record. You see that in case of a complete record, you start with what? Yeah, you adopt the bottom up, right? You start from the net profit, you add back desirable expenses. Can you go back to the format? Go back to your notes where you had the format. In case of incomplete record, we say that you take the reported profit, then you add back desirable expense. So that means one of your major concerns are desirable expenses. You also add what? Yes, Allowable expenses never deduct. And that one mostly is the investment allowance or the capital allowance. Number 3, you raise what? Non-taxable income, right? So also in this case, you need to focus on non-taxable income. Also, you raise the specified sources of income. So now let's go step by step. Now let's start with the incomes. Now for incomes, we see that it's either taxable or non-taxable. Interest on loan and advances from customer. Is it taxable or non-taxable? Kuna kitu nimwambia, all incomes are taxable except non-taxable. So we have said that for the bank, their major source of income are the interest, right? So ukiwa na interest, know that it's an operating income. Therefore, it's a taxable. Good. Interest on loan and advances from customer, taxable and taxable. Taxable, adika T, usiandike taxable, just the right T. Loyalty income. No, royalty is a taxable, but it's only that it's among the specified source of income. You said it's taxable, but it's among the specified sources of income. Interest on treasury bills. Adika taxable. In the bank, well, ukiwa na interest, unajua is a income, which is taxable, right? It's an operating income. Interest on placement with other banks. Taxable, just right. Fees and commission. That's taxable. See, they usually do charge you for having an account there, right? Yeah, so to the bank is an income, which is a day-to-day income. So it's taxable. Unrealized income from foreign exchange transaction. Non-taxable. Yeah, we see that all unrealized income are non-taxable. Yeah, that's why I told you, can you go and review? All the non-taxable income should be at your fingertips, as well as disallowable expenses. Profit on sale of furniture. Non-taxable. Yeah. I remember explaining that here, that all the capital gain on disposal of the asset are non-taxable, right? NT. Now let's go to the expenses. Now expenses, it's either allowable or disallowable. Now what we need here, you see we are adopting the other method. Net profit, you add back disallowable expense. So in this case, we're only now concerned with the disallowable expense. Number 1, staff cost. That's allowable. That's an operating expense, right? Occupancy expense, allowable. Is only the rent and expensive. Impairment loss on goodwill, it's allowable. Yeah, we said impairment, depreciation, amortization. Depreciation is allowable, right? D. Deposit protection fund contribution. Now, previously that used to be allowable expenses for the bank, but nowadays are disallowable, right? D. Interest on customer deposits, allowable. That's actually their major expense. Are we together? Yeah, it's an operating expense. Interest on deposit from other banks, allowable. Good. Interest on directors' remuneration. Directors are allowable. Are we together? Yes. Audit fees. Now, for audit fees we have for the current year, that is allowable, right? And a provision for previous year, that one is disallowable. Here it last year, and actually it was a provision. Are we together? So that all provision are disallowable expenses. Operating lease expense, that's allowable. Operating lease, instead of buying an asset with lease, so that lease rentals paid are allowable. Loss on disposal of equipment, disallowable. Kazi yetu si kuuza equipment, because we have said that in case we said we sell an equipment at a gain, that gain will not be taxed. Are we together? Therefore, if you sell it at a loss, that loss should not be allowable. So therefore, it's disallowable. Finance cost. The finance cost is the interest on borrowings. Are we together? Interest expense is allowable expense. So that one is allowable. Provision for bad and doubtful debts. Yeah, we see that it's only allowable when it's specific, but general provision is a disallowable expense. So you might be given, we'll be given some more information on that. Provision for interest in suspense. D. Nilimwambia ukiona jina provision, all provision are disallowable. Yes, we have not paid that expense. It's just a provision. So all provision are disallowable. Then we have net profit. You want to say that it's additional information. Staff cost include, number one, provision for salary increase. Disallowable. Yeah, all provision are disallowable. Pension contributions. Pension contribution. That's allowed. So it's a day-to-day expense, right? Allowable. Staff terminal cost. Staff terminal cost. It's like what we call severance fee, right? The staff terminal cost. Allowable, disallowable. Here than staff. So kumaanisha it's an operating expense. So therefore it's allowable. Provision for staff repairs. Disallowable. It's a provision. Number two, provision for interest in suspense related to non-performing loan advanced to the executive director. So that one is not applicable. Operating risk expense related to photocopy list from farm dealing in office. Surprise. Number four, directors' remuneration include. Directors' remuneration include school fees for the, yes? Sorry? Operating? Okay, they are trying to explain the expense given in the 12 barras. Now, tusema operating, this operating expense, the allowable expense? Expense, yes. The allowable expenses. So, directors' remuneration include, number one, school fees for directors' students. That one is, it's a private expense. Expense, yeah. Tunalipia directors for watoto wake shule. That is not a business expense. Grant entertainment allowance. D all R. Client, we are entertaining our client. Are you together? So that one is a business expense. Expense. How can you entertain your client? Buying lunch. Entertainment is not about food. Okay, it's okay. You can buy for them food. You know, also free Wi-Fi is part of entertainment. Yes, I remember when I was in college. So even if I want to pay school fees for 500, I'll make sure I go to the bank. And takwambia pita kwanza. Because you know there is free Wi-Fi. Ilikuwa kitambo sana. Internet haikuwa, free Wi-Fi haikuwa like nowadays. So that was way back in 2013. So unaenda kwa bank. Kuna mahali nilikuwa naenda, there was a free Wi-Fi. So kwa ningekaa 2 hours. I'm only depositing 500. After that, nime download all the games nilikuwa nataka, all the books I wanted, because I used to have the e-books. And I download, I talk up as a happy person. So that's part of current entertainment expenses. Then we have passage for expatriate director. That one is allowable. Number 5, provision for bad and doubtful debts comprise. Now remember, you see that provision for doubtful debts will only be allowable if they are specific. Generally, they are what? Disallowable. Now, this is a complete record. So we are taking the net profit, we add back what? Disallowable. So in this case, we only focus with disallowable. Right together. So now we need to look at the general expenses. That's what we are focused with. Now, for the general provision, you are given 1st of January 2011. Those are opening balances. Charge for the year. How much the charge for the year for general provision? How much is it? Let me repeat again. Now we are looking at general allowance provision. Are you together? We have looked at the 1st January 2010. That's the opening balance. Then charge during the year. How much general? Now that charge for the year is what they took to the income statement and should be treated as a disallowable expense. Now the opening balance, the closing balance, that one does not affect, because after all, you only take the charge for the year. So in that case, can you take 72? Take 72. So that's what will add back to the as a part of disallowable expenses. Number 6, capital allowances for the year were agreed at 8.4. Good. Required. The an adjusted statement of taxable income for the year ended that 1st December 2010. So this was Pesa Commercial Bank. Computation of taxable profit or loss for the year ended that 1st of December. So this is a complete record. So it starts with the reported profit. How much is the reported profit? Or the net profit. So you start with the net profit. Yeah, we had an amount of 213,270. Yeah? Then we add back disallowable expenses. Now let's go back to the expenses. What we had included as D. So at the expense we had staff cost, right? No, staff cost is allowable, right? And you go to number one. Number one, you're told that staff costs include. So we had some disallowable expenses. Yes, provision for salary increase. Provision for salary increase, an amount of 480. Also, we had provision for staff leave arrears, an amount of 86.80. The other expense we had was impairment loss on goodwill. Impairment was an amount of 8,700. We also had depreciation. Depreciation was an amount of about 6,800. A deposit protection fund contribution. That one was an amount of 10,360 because it's payable once in a year. So therefore it's recorded as a fixed expense for the year. Then we also have directors' remuneration. Can you go to note number 4? Now, note number 4, you're told that directors' remuneration include school fees for directors' children, an amount of 1,600. Do we have any other? No. Go back to the expenses. We also have audit fees. For the current year is allowable, but we had other provision for previous year. Amount of 400. We also had loss on disposal of equipment. The loss on disposal of equipment was an amount of 19,640. You add it back. Finance cost is okay. Then we have provision for bad debt. Can you go to note number 5? Note number 5. There is something I told you to tick. That's the general allowance, the charge for the year. Now, the charge for the year is what now they had already deducted in the income statement. And how much was it? 72. That was the charge for the year. That's the expense they had included to the income statement. Then we had provision for interest in suspense. An amount of 20. Is that 2,400? Yeah. So you see that you add back all disallowable expenses, then you deduct what? Then you raise allowable expenses never deducted. And which are those allowable expenses? Number one, we have the capital allowances. Can you go to the last note? Now, once you add back all disallowable expenses, now you deduct allowable expenses never deducted, and that's the capital allowances. An amount of 8,400. Also, you raise now non-taxable income. You see, the net profit for the year had included all the income and expenses, but we have some incomes included here which are not taxed, so we eliminate them. So now let's go back to an income statement under the incomes. The first one was what? Unrealized income. An amount of 93.60. Also, we had the profit on sale of furniture. Profit on sale of furniture, which is an amount of 43.80. Also, we see that you also deduct specified or specific incomes. Still at other incomes, we had one, royalty income, of which we are told that is net of withholding tax. So royalty was an amount of 95. You deduct that, and that's how we get our taxable profit. So how much would be a taxable profit? So in that case, we'll have an amount of 295,890. Now, once we have the taxable profit, now this is what we call now the business income, the profit from day-to-day operations. Now we can add specific or specified sources of income, specified incomes. And we only had one. What was that? Royalty incomes. Now let's be here. You are told that the royalty income was net of withholding tax. Now we want to add it because what we have done, we have deducted what they had already added. Are you together? But if it's net of withholding tax, if you add it at 95, it will be taxed twice. Are you getting? So you have to take it back to the gross. So we take it back to the gross. So it's 95. The withholding rate for royalty is how much? There is something I told you to write. We say that all withholding tax at the rate of 5%, except for what? Interest and dividend from SACCOs and cooperatives. Yeah, apart from the interest and dividends from SACCOs and cooperatives, all the other withholding taxes at the rate of 5%. So you divide by 0.95. So how much was the gross amount? It was 10,000. That's how you get our adjusted taxable income. And our adjusted taxable income will be an amount of 305,890. That's how we determine the adjusted taxable income. If you're to get the tax liability, you'll just take 30%. How much is this? Of 305,890. They're supposed to pay a tax of how much? $912? 767. Good. As simple as that. So you have answered part one. Now, part one of the question was, part one of the required, we are told that. Assuming, adjusted taxable, a statement of taxable income for the year ended that 1st December 2010, we have done that. Number two, now assuming Pesa Commercial Bank taxable profit for the year ended that 1st of December, that is 20. Are we reading from the same question? Ngapi? Kama hata nyinyi hamuoni. Mnaona ngapi? Assuming Pesa Commercial Bank Limited taxable profit for the year ended that 1st of December was 560 million. Calculate the final tax that was due on or before 30th of June 20. The final. Now, the question is asking about the installment tax. Now, 2014 going backward, they used to pay in 2 installments. 6 months, after 6 months, that means semi-annual, right? Then at the end of the year. But from 2015 now, you pay 4 times, right? So it's all about how to determine the installment tax. Because in this case, they were asking about the final tax. We say that installment tax, you'll take the previous year's tax, then you multiply by what? 110%. Now, this is 2010. So the previous year tax was 209. How much was the tax? Hey, tusikize hapa. Sijui mnaandika nini. Tunasoma part B. Someni tena mara ya 3. Are we there? So you're given the taxable profit for the previous year, which was an amount of 560. Then you multiply by 30%. Now, I said you take previous year tax. What you're given is not previous year tax. You are given what? Taxable profit. Are we together? If the previous year taxable profit was 560, you multiply by 30. First of all, determine how much was the tax, right? Then you multiply by 110. 160. 184. Yeah, how is this amount supposed to be paid? So now it will be paid on or before 20th of 4th month, 6th month, 9th month, and 12th month. Here it will pay, this is in April, right? This is in June, September, and December. Then we pay quarter, that's 25% of 184,800. 25% of 184,800. 25% of 184,800. 25 of 184,800. Divided by 4, you get 46, 200, 46, 200, 46, 200, 46. So that means by the end of the financial year, they could have they'll have already paid an amount of how much? 184,800. So that's what they wanted. Now, what will happen now? Now you're done answering the question. By the end of this financial year 2010, you had already paid how much? 184. But a preparation of the financial statement, this was the actual tax liability. Got it? But you had already paid how much? There was an overpayment of how much? So the tax paid, they had already paid 184,800, but the actual tax liability was supposed to be 91,760. So there was an overpayment. Now that's what we call tax asset, because to the company, they will not pay. So in short, it's tax refundable or recoverable in the future. An amount of 93, 033. So that's the overpayment. Now this tax is to be offset against the next year tax. How? Tuangalie hapa next year. Next year, we want to determine the installment tax for the coming period. You'll take the previous year tax. How much is the previous year tax? DOE. Sawa. 91,767. You multiply by 110. They want to determine for that. The other coming financial year, that's 2011. How much would be the tax? It'd be how much? It's answer you multiply 109.40. This is the tax for the coming period. But already they have an overpayment of how much? 93,033. Kwa hivyo wanajua hiyo KRA deni yao ya hiyo mwaka yote ni ngapi? 79. So now they'll take 79, 11, they divide by 4, right? 25, 25, 25, 25. Good. So we shall do another question on banks in our next session. So that's the end of that session.